Today, we are taking an analytical deep dive into Zijin Mining Group. Now, this is a global mining giant that sits at a really interesting intersection. It's riding a very strong commodity cycle, while at the same time executing an aggressive growth strategy. So in this analysis, we're going to dissect the data to build a structured, objective view of the key forces that are shaping its future.
We're going to begin with our conclusion first. This is the core thesis, and it really outlines the central narrative. You have a company that's capitalizing on a major commodity upswing, but it's also navigating a very complex landscape of significant, underlying risks.
So our core thesis really rests on 5 key pillars. First, you've got this exceptional outperformance in the market, and it's being driven by factors specific to the company. Second, there's a powerful tailwind from the supercycle in gold and copper. Third, we see really sharp strategic execution across projects, acquisitions, and its financial moves. But on the other side, there are emerging questions around whether profitability is peaking. And finally, all of this is happening against the backdrop of heightened external risks that really demand careful consideration.
Okay, now let's ground this thesis in the hard data. We're going to quantify the company's recent market performance to really understand the scale of its divergence from the market benchmarks.
This figure is quite striking. In just a recent 6-week period, the stock generated nearly 25% in alpha. That's the excess return above the market against the CSI 300 index. The crucial point here is that this performance wasn't just the market lifting all boats. It was overwhelmingly driven by factors unique to the company itself.
And this chart really visualizes the magnitude of that divergence. While Zijin posted a gain of almost 25%, you can see the broader CSI 300 index was basically flat. Even its own industry benchmark was up a much more modest 8.7%. This data really confirms a performance story that's being driven by internal catalysts, not just sector-wide tailwinds.
So this level of outperformance really demands that we look into the underlying fundamentals. What precisely is driving the financial engine of this business?
The DuPont analysis gives us a very clear answer. This framework breaks down return on equity into its 3 core drivers: profitability, which is net profit margin; asset efficiency, which is total asset turnover; and financial leverage, the equity multiplier. And the data here is unambiguous. The dramatic increase in ROE from about 20% to almost 34% is almost entirely coming from the expansion in net profit margin. You can see that asset efficiency and leverage have remained stable. This points to high-quality growth fueled by core profitability, not by taking on more debt.
So if profitability is the story, what's behind it? Well, the fundamental picture is really being propelled by 2 primary forces: a favorable macro environment for its key products, and a series of very deliberate strategic initiatives by the company.
Now, on the commodity front, the company is navigating what is essentially a split market. For its core products, copper and gold, the outlook is supported by big structural demand from the energy transition and AI, and that's coupled with supply constraints. On the other hand, the lithium market is currently working through a period of oversupply, although the long-term demand picture there does remain quite strong.
So, in response to this environment, the company has deployed a very clear, multifaceted growth strategy. You could think of it as being built on 3 distinct pillars. First, driving internal growth from its project pipeline. Second, pursuing external growth through strategic acquisitions. And third, using financial engineering to unlock the value of its assets.
And these aren't just theoretical pillars. We can see them being actively executed. For example, the expansion of major copper assets like the Tibet-Julong mine, or the integration of key acquisitions like the Akiem gold mine. And, of course, the value realization from that multi-billion-dollar IPO of its international gold division.
A thorough analysis, however, always requires a balanced perspective. So this compelling growth narrative has to be weighed against a set of material risks that could absolutely impact the company's future performance. We've structured our assessment here in a risk matrix, looking at both probability and potential impact. 2 categories immediately stand out as high impact. First, geopolitical risk, which comes from having a concentration of assets in jurisdictions like the DRC and Serbia. And second, commodity price risk, just given how sensitive earnings are to a global downturn. These 2 really warrant the most serious consideration.
And the gravity of this geopolitical environment is certainly not lost on the company itself. This statement from their own management directly acknowledges the unprecedented uncertainty and the high-intensity nature of the global contest for resources. That really underscores the external pressures that they're facing.
On the operational front, we see a similar level of candor. This quote from the chairman's address in the 2023 annual report points to a severe safety situation and shortcomings in safety management. Now that's a critical ESG data point,
and it highlights a significant internal challenge.
So these risks really form the basis of the counter-narrative. And the key arguments against the bullish case center on three big questions. First, do current valuation multiples already reflect a best-case scenario for both commodity prices and project execution? Second, are we actually seeing peak profitability, as suggested by some emerging margin pressures? And third, is the market adequately pricing in the probability of a high-impact geopolitical or operational disruption?
And that brings us to the central tension of this whole story. On one side, you have these powerful tailwinds from commodity markets and a clear, well-executed growth strategy. But on the other, you have significant and acknowledged risks in the geopolitical and operational spheres. So the fundamental question isn't if one of these forces will dominate, but rather when and which set of factors will ultimately define this company's next chapter.